Welcome to Season 2 of the Crypto Pulse podcast, your ultimate guide to the world of crypto, Bitcoin, and world economics. We're here to guide you through the crypto universe with thought-provoking topics, in-depth knowledge, and information to help you make informed decisions. We'll also be interviewing some of the best minds in the industry, such as CEOs of crypto projects, traders, economists, authors, and development teams from around the globe. And now for the episode.
Greg Foss, welcome to Crypto Pulse. How are you?
Well, I'm doing well, guys. Thanks so much for having me. I'm currently on the East Coast of the USA. I am a Canadian, but I'm in the nice state of Maine right now.
Very nice. What are you doing in Maine?
It's a childhood. I've been coming here since I was under 5 years old. So for the last 50 years, it's been a family vacation spot and doing some paddle surfing. I got two boys that like surfing. I have a daughter who likes boogie boarding. So, fun in the ocean.
Nice. That's the life.
Does sound like the life to me. Yeah. We're so excited to talk to you. We were just saying off air, I feel like I know you quite well, even though you've not spoken to us before, because Ben and I have both listened to various YouTube videos. And I think I first found you on Real Vision, actually. I think it was a conversation you were having on there. And then I watched some other videos, and so this was really cool. I think I watched some of your stuff, and then like a few weeks later put a post out on Twitter. So this was on the 23rd of June, so about a month ago, and I wrote, podcast guest, can you help? I want to speak to a seasoned macroeconomist to discuss inflation and repercussions, the impending global recession and how the economy can recover, CBDCs, and the role of the Fed, IMF, and World Economic Forum on global policy. Any takers? And then a few people tagged you, and you were kind enough to message me back, and here we are. So that's a lot that I wrote on that tweet. So I don't know how much time we'll get today, but one of the questions I get asked all the time is, the world is in so much debt. Who do we owe all this money to? And it's a question not just people in the crypto community ask, but in everyday life. And I don't think even people in the Bitcoin community don't really understand the answer to that question. So maybe we could start there. And I know that's a big question, but what would you say to somebody if they asked you that?
What a great question. Well, let's start with the reality that they can't tell you or teach you this in school, because if they did, at a very young age, most people would start questioning, isn't the country being irresponsible? I mean, if an individual borrowed this much money, they'd be maxed out on their credit cards, and it's the equivalent of maxing out on one credit card and then getting another credit card to pay the interest expense, only the interest expense on the first credit card, So let's start with some numbers. In the total global financial assets, which are approximately $900 trillion, global debt is $400 trillion of that. And of that, a large portion is government borrowing. And so of the government borrowing, in the case of the United States, there's $30 trillion that is borrowed by the US government. And I believe your question was, who lends them the money? Now, traditionally, the lenders have been pension plans, commercial banks, mom and pop investors by way of mutual funds, or mom and pop investors by way of buying individual treasury bonds. Certainly, I know that my grandparents, for example, bought Canada savings bonds. And think of it as somebody who has a portfolio of investments that is lending money to the government, and they pay a coupon on that debt that reflects the riskiness of the government. Now, you have learned in school that the United States Treasury, for example, is the quintessential risk-free borrower. I don't want to get too granular. I don't believe that's the case, but amongst lenders in the world, if they want low risk investments, they buy US Treasury bonds or gilts or German bonds. What's happened recently, though, is because their globe has become so indebted, some of the major buyers of the bonds are other global central banks. So the US Treasury, or the Federal Reserve rather, owns a ton of US government debt, but the US government or the US Treasury also owns Japanese government bonds. So the newest buyer on the block is other foreign central banks, as well as your own central bank. And that's where the difficulty arises. When you are essentially printing money, the process is the government buys their own bonds back and it becomes circular. And that's why, as a Bitcoiner and as a 30-year trader in credit, I view the debt spiral, DEBT spiral, as being the most important critical matter facing global financial markets.
Following on from that, Greg, I mean, in your eyes, because I've heard you talk about how Bitcoin is math and code, and that fiat is programmed to debase. I mean, in your mind, how long do we have? I mean, because this thing just looks so unbelievably unsustainable. I mean, are we talking decades? Are we talking years?
And so nobody knows for sure. Ben, another great question. I love your questions, by the way. No one knows for sure, right? All I know, I have the old trading adage that risk happens fast.
Right.
Okay. You think everything is going along swimmingly, and all of a sudden there's a crisis. And generally that crisis, if you look back to the great financial crisis in 2008, 2009, everyone, if you listen to all the talking heads, the subprime mortgage crisis is contained. Oh, don't worry. We think it's a blip on the radar. And then all of a sudden the world imploded, right? Now, the same thing could happen with global sovereign debt. And the difference is that it has happened meaningfully in the past. It just hasn't happened to the big, call them G7 nations, okay? But Argentina, I frequently point out, has defaulted 4 times in my career. I started my career in 1988, and Latin American debt was in a crisis in 1988. Argentina wasn't the only Latin country that was in crisis, but since then it's failed 3 other times. Like, think about that. I'm close to 60 years old. A 30 bond issued by Argentina has never matured in my lifetime.
Wow.
They raise money for the next 30 years. Well, guess what? It's defaulted, not once, 4 times. So there's serial defaulters in the world, but they just haven't been G7 countries. That's my biggest fear, is when it hits the G7 nations. And let's talk about the Eurozone. Right. Because you guys, the UK, you guys have made a decision, and I think it's quite wise personally, but
it depends. It's probably good to get out, but I don't know if we have a plan once we're out. That's the thing we're waiting on now. It's like, okay, now what? Like, what's going to happen? But I'm sorry, I cut across you then.
It's
so
okay. It's good.
On.
Look, I don't want to get too political. I understand there's supporters and detractors on every subject, but Germany's the only is holding that union together with baling wire and masking tape, basically, right? Because you have the southern countries that in the absence of a European Union, Italy, Portugal, Greece, and Spain would all be in severe financial distress. Germany's holding it together, but their economy is starting to really show cracks. Germany hasn't grown economically in 5 years. And then all of a sudden, there's got to be some citizens in Germany that say, why am I the guy working when all these other guys in Southern Europe are living off of my hard work? So there could be some social unrest. I mean, so I guess a long-winded answer to your question, if something starts fraying at the edges, it can happen very quickly. Can they hold it together for decades? Absolutely, because this has been going on. The only time it became unsustainable was with the response to the global financial crisis. They had a chance to pay down the debt that they incurred due to the global financial crisis. They chose not to, right. And then they reacted globally to the COVID crisis that makes it mathematically certain right now that this is very scary, as Ben pointed out.
And how does Bitcoin play a part in all of this? Because this is a question we get asked all the time, and we bleat on about how we're in a debt spiral, and the fiat system can't continue this way. But for our listeners that are maybe just finding out about Bitcoin and its properties, why is it so important as a kind of hedge against this?
To be clear, I am a supporter of Bitcoin as my focus in the digital asset space, because I believe Bitcoin to be the only digital asset that can solve the fiat ponzi.
Mm-hmm.
Okay. And the fiat ponzi is another word of saying, the debt spiral, the continuous printing of money, the fact that commercial banks globally are levered 25 times to their risk absorbing capital base. Okay. That's a fact.
Wow.
No one understands how truly risky commercial banking is. So it is a fiat ponzi. The whole system is built on sand. And I say that from the experience of a 30-year credit trader. Okay. I've seen 4 global financial crises in my life. Bitcoin, in my opinion, is insurance against the fiat ponzi. No other digital asset can be that for various reasons. The most important one is scarcity, defined supply, okay? The finite supply of Bitcoin is defined. And then the second one is the decentralization aspect, okay? There is no group controlling Bitcoin. There's no CEO. And you can compare that to other digital assets that you can argue have, undefined supply that have much higher degrees of centralization. So Bitcoin is my solution. It's the insurance that I look for. And as a hedge fund guy for 30 years, I always look for trades that would hedge the risks. I like to think of Bitcoin as insurance, okay? Specifically credit insurance. And having spent my life trading credit default swaps, having been in the trenches during the great financial crisis, trust me, things happen fast. They unravel quickly. And you need to own insurance while it's cheap. So I'll just summarize by saying, I believe Bitcoin to be the best asymmetric investment opportunity I have ever seen in 35 years of managing risk.
It's quite an astounding statement, really.
How do you think we integrate Bitcoin into the traditional finance system? So you've got these pure Bitcoiners that have been around for, maybe 10 years, maybe not as long as that, but people that really believe it's people for the money and the institution shouldn't go anywhere near it. And then I've listened to various people talk about it, yourself, Roll Powell, listened to, you talked to Peter McCormack about this as well, about it possibly being a really good thing to put into pensions. But how does because in my mind, and correct me if you think I'm wrong here, by all means, but in my mind, Bitcoin is the life raft for the fiat system in a way, because the fiat system isn't going to go anywhere. But to integrate Bitcoin into that in some way gives it that stability and gives people exposure to Bitcoin that maybe don't want to store it on their hardware wallet. They want it in pensions. They want it in savings accounts, in other methods. So how does that work? How does it become adopted?
Another great question. So Kevin, I guess let's start with the fact that, Bitcoin is only 13 years old, and the level of adoption is quite astounding, in my opinion, right now. But the scenario you laid out is the optimistic scenario. It's where you're developing a parallel system. You said the fiat system isn't going to go anywhere. I'm not so sure about that. I hope you're right, but I'm not positive you're right, and that's why you need the insurance. But let's say that there's an optimistic scenario where you're developing a parallel network, one called Bitcoin, that will be the most important store of value ever created for mankind, and therefore should be exposure for not just pensions, but eventually central banks as well. Okay, I firmly believe, as a Canadian, I would love our central bank to consider buying Bitcoin. After all, we sold all our gold. Canada owns no gold. Our reserves, central bank reserves, include 0 in gold. So how does it happen? it's a process. It's an education process. It happens with events like just recently announced BlackRock. The world's largest asset manager is now offering Bitcoin to its clients, which includes pensions. It includes high net worth individuals, family offices, etc. How does that happen? Well, BlackRock most likely had to do it because Fidelity, the number 5 global asset manager, did it and offered it for its clients. And BlackRock was getting pressure from its own clients to offer it. And if they didn't, they would lose to Fidelity. So it's a process. Education. There will always be detractors. There will always be Peter Schiffs of the world that don't do their homework, that insist that that Bitcoin's going to zero. But then there's smart people that change their thesis as the information changes. And BlackRock is, a bit of both of those. BlackRock was kicking and screaming, probably making this decision. After all, 2 years ago, they made some very derogatory comments about Bitcoin. And then 2 years later, they're offering it to their clients. Why? It's a little push-pull. The clients were pulling them towards it. They realize on a diversified asset basis, and here's the kicker, the bonds in the world, we talked about the bonds in the world being the largest asset class that you can invest in. They are really in trouble, okay? And anyone that owns bonds knows that that's not a very attractive place to store your money. It's a fiat contract, as Ben pointed out, that is programmed to debase. So push-pull, adoption, you know what it really is? When the old white fat guys like me stop managing money and the young kids who have grown up with Bitcoin on their wallet, no, there's my wallet with my Bitcoin sticker on it, okay? It's called an iPhone. The young kids that know this because they've grown up with it and they start making the decisions on how to allocate money, that's when the real change will happen. So long-winded answer again, but it's a process. And here's the very important thing. Yeah, Bitcoin is only 13 years old. Like, this is an asset that every single day that it survives, it becomes more in the conscience of the investing public. And every single day that people start doing the math on the US Treasury, doing the math on all global central banks, they realize something could break and it could be ugly. And, it's wise to diversify your risk baskets.
So a diversification we talk about often on the show, and it's interesting you mentioned Peter Schiff just a second ago. I actually enjoyed the debate you did with him, I think a couple of years ago, on what Bitcoin did. I think you described him as a horrible risk manager. But
it was 1 year ago. I was in this exact spot 1 year ago. So
it was a great debate. I mean, I've never watched someone feel so confident in their position, and Peter Schiff, I don't think he'll ever budge. But I mean, you talk about diversification. Do you think there's a place for gold? I mean, like, talking about the debasement of the fiat system, do you think gold fits into that in some respect, or do you see the future as purely digital and Bitcoin being the king?
I absolutely own gold. One of my good friends, Lawrence Lepard, who is a gold bug who sees the attributes of Bitcoin as being superior. But I've always managed risk by never throwing all my eggs in one basket, right? I'll just say this. I own gold. I own real estate. I own metals. I own hard assets. I own Bitcoin. I do not own bonds. That I am categorically against bonds at these levels of interest rates. I do not believe they adequately compensate you for the risk that you are seeing. That being said, bonds are the biggest asset class in the world. If you're going to allocate to hard assets and Bitcoin, my advice is to take it out of your bond allocation and move it to your hard asset basket. So the traditional, you've heard the word 60-40, 60% equities, 40% bonds. Let's put another asset class in there called hard assets. And I would advocate 60-30-10. And again, the 10% comes out of your bond portfolio. And in your hard asset portfolio, the one that I believe has the best asymmetric return opportunity is Bitcoin. It's slam dunk, the best opportunity I've ever seen. But I'm not saying go 10% weighting. All I'm saying is go bigger than zero. If you have 0% weight in Bitcoin, you're actually taking a tremendous amount of risk relative to someone who has 0 to 5%. So get yourself to 5%. Here's the crazy thing. Once you're at 5%, it's like you forget everything else you own. And you're focused on this Bitcoin thing. But guys, you have 95% of other stuff you should really be worrying about. Bitcoin is a 20-year time horizon. And over that 20-year period, I believe that Bitcoin will attain prices in fiat that will make your head spin. For example, I have a price target. It's a target, not a limit, of $2 million US per Bitcoin in today's dollars. Wow. And I can tell you how I get there. But the other thing is, as a risk manager, and I want you guys to understand this, I'm not 100% certain. But if you calculate the probability that the market gives me of being right, you take the current trading price of 20,000, you divide it by 2 million. The market is telling me I'm only 1% chance of being right. And I'm like, okay, I'm not 100% certain, but I'm way more than 1% certain. If you had to ask me what my degree of certainty was, I'd say, you know what, about 40%, which means until Bitcoin trades for $800,000 per Bitcoin, I would argue you buy it with your eyes closed. You don't buy it all at once. You use dollar cost averaging and you focus on the long term. You focus on where the rest of the risk is in your portfolio, including bonds, now, I think, gold belongs in a hard asset portfolio. Other people think, no, you should only own Bitcoin. And that's where we can agree to disagree, because if you still own bonds and you don't own gold and you don't own Bitcoin, I think you are the one that's exposing yourself and your family and your kids to a high degree of risk.
I want to track back to something we were talking about earlier about countries and debt, because I know I asked you the opening question about who do we owe all this money to, but I want to talk a little bit about the IMF, because I don't know a huge amount about them, only what I've read, and a lot of people don't even know the IMF exists. And I'd like to talk about what their role is in the world. Let's start there. So who are the IMF, and how do they create this money to lend to other countries? And have I even got that right? No.
Okay. Yes, you're right about. So the IMF, International Monetary Foundation, okay, it's a fund, and IMF probably International Monetary Foundation or a fund. It doesn't matter. It is a fund, and it's basically funded by rich countries. Read United States. Okay. It is a fund that is established to help struggling nations deal with their own debt, call them crises or challenges. And the IMF is out there as an organization to balance, if you will, global economies so that global trade doesn't fall apart. As the world's most important and world's largest economy, the United States has to worry about all the other emerging economies that they trade with, that create demand globally for a global economy. And so that's what the USA and the IMF have as a goal. We could go right now and read what their goal is. And there is no central bank. The IMF is not a central bank. So I believe you said, how does the IMF print money? No, it's the Federal Reserves and the central banks of the countries that fund the IMF that print the money. The IMF is the beneficiary and can make their decisions, as to, on a country like El Salvador, on any emerging usually emerging economies, on how to help them fund their growth, stabilize their structures. So IMF is it's a global financial player, but it is not its own money printer.
So if the IMF receives funds from central banks, so let's just take the Fed, for example, it's probably the best one to use. And the IMF then effectively, what do they do then? Loan money to developing nations? And
correct.
Right.
Yeah.
So I've read different things about what the terms of those loans are. I've read conspiratorial stuff. I've read stuff that seems a bit more institution and politically friendly. But I thought the idea of them is that they're going to support these countries and then they can pay the money back and they've helped that country out. But now it seems like they're almost like investing in these other countries. And then I'm thinking, well, actually, if the IMF are receiving funds from the Fed, for example, and the Fed are giving the IMF the money and the IMF are giving it to developing countries, isn't it just the Fed trying to fund these other countries on their conditions?
Yes, but let's no, man, it's really good. It's really good. But I think that, I try and, there's plenty of conspiracy theories that we can go down that are even more egregious than the IMF.
I was trying to keep it
absolutely
sort of
right.
Straight-laced. I like to talk about facts and I like to try and get to the truth. That's what I think a lot of our motive is. So I didn't want to go too wild. Yeah, well done. Well, Kev, let me be very honest here. I am not an expert in this. So I tend to be an expert in evaluating credit risk. Right. Having done it for 30 years and credit risk of corporations specifically, but the math is all the same, whether you're evaluating the credit quality of a corporation versus evaluating the credit quality of a company, of a country. It's the same. You look at things like interest coverage ratios, you look at all this. Now the IMF, there's no question that, they get their hands in things like they've commented on El Salvador. They are putting citizens at risk, making statements about El Salvador that, in my opinion, are absolutely irresponsible. Just because they don't want El Salvador's Bitcoin experiment to succeed, do they have the right to jeopardize the livelihood of 6 million citizens with a statement that, this is very dangerous and the IMF is not going to fund El Salvador's maturing debt in the next 2 or 3 years? Look, guys, this is the dangerous part of it. You start bringing in these players that, and gosh, I haven't even started on the World Economic Forum. I mean, who elected these people? So let's be careful to, I'd rather keep it on the level of, central banks and Bitcoin and how Bitcoin can actually help central banks. You have the Steve Hanke's of the world. I'm not sure if you in the UK know who Steve Hanke is, but he's a professor at John Hopkins University in Maryland. And the guy he's quite remarkable in his ability to call all the catastrophes of the world, the Fiat catastrophes in Latin America, in Turkey, in Lebanon. Yet he doesn't have a solution. Like he's out there with gasoline pouring on these fires, and the solution is Bitcoin. But he is too woven into the traditional, system that he won't think outside the box. And I'm a huge fan of what they're trying to do in El Salvador, of President Bukele. I'm an absolutely huge fan. Why? Because it wasn't working, and it was certain that the path they are on would lead to a continuation of suffering of their own citizens. So what has happened since El Salvador started to embrace Bitcoin? Tourism has gone through the roof. And I have a little story for you guys. You'll like this as UK guys. I'm a partner in 8 Irish pubs in Montreal, okay? And we're really good operators. We've been doing it for 25 years. And I'm not bragging here because I need to tell you this. The pub business is a really tough business, okay? We're good operators. We have what's called a free cash flow margin of about 14%, which is simply to say for every dollar of sales we make, we collect 14 cents of free cash flow, dividend opportunities to pay back to the partners. Now, that's not a great number. Apple
Apple, for example, largest publicly traded company in the world, has a far better free cash flow margin than my pubs. The point is, there's lots of pubs in the world. When someone takes out a credit card in Canada to pay, our 14-cent profit margin goes down to 11.5 cents because we have to pay what's called a merchant fee for credit cards, right? That's Visa, MasterCard, all the card companies charge merchant fees to the merchant, not to the credit card owner. It's the weight is borne by the merchant. So we go down to 11.5%. Do you know what credit card fees are in El Salvador?
No idea.
They are 8%.
Wow.
8%. So think of that. You're a really good restaurant in El Salvador, and your 14% margin goes down to 6% when someone pays with a credit card.
Is that because of the risk profile of El Salvador? Is that why it is? So Visa and MasterCard say
no. It's because the traditional finance companies can charge a larger freight, if you will. They are more egregious. The ability to charge these numbers are accepted. And therein is the problem. If you were to pay with Bitcoin, it would be almost frictionless. It would be the restaurateur keeping the 14 cents. And we're doing the same thing in our pubs in Montreal. We want people to pay us with Bitcoin because we avoid having to pay 2.5% to the credit card company. So there's another way that El Salvador is increasing their GDP. And here's a really good kicker, okay? 20% of El Salvador's economy is what's called remittances. It's when they have El Salvador workers that go and work in the United States and then remit money back to their families in El Salvador, right? Western Union, which is one of the biggest remittances companies in the world, charges 20% fee. Okay. And 20% of El Salvador's GDP is remittances. On that, Western Union is charging a fee of 20%. That means 20% times 20% is 4%. That means 4% of El Salvador's GDP is being eaten up by the intermediaries like Western Union for remittances. Holy moly. So Bukele's put together all this, put it in place, and he's seeing real economic benefits from this. And it's not making the traditional credit card companies happy. It's certainly not making Western Union happy. By the way, Western Union is going the way of Blockbuster Video. So sorry, Western Union, your business model is a piece of, dated technology.
Leeches.
It's just the way it is. And this is called creative destruction. This is part of capitalism. So all of these things, I'm a fan of what's going on in El Salvador. IMF is not a fan of what's going on in El Salvador. And guess what? I love freedom, okay? I want El Salvador to be victorious, which is to say, I don't have a lot of time for the IMF cheerleaders who want El Salvador to fail.
Right. I was going to say, for any of our listeners that are interested in some of the darker sides of what the IMF do, is a great book called Confessions of an Economic Hitman. It's that old classic by John Perkins, which talks a little bit about some of the work that they used to do and how they used to use these loans. But on a separate subject, I kind of want to move us on to some of the short-term stuff that's going on with the Fed at the moment, Greg, because I'm just interested to kind of get your perspective on this. Obviously, we're starting, this is a global phenomenon, right? We've got inflation running hot pretty much everywhere. We've got, different central banks approaching this differently. Japan are kind of going down this yield curve control route. You've got the Fed that are now raising interest rates. Where do you think this is going to end? I mean, do you see that inflation is just going to keep running hot? I mean, does this term transitory, does it actually mean anything? Or we just, have we actually just transitioned into a world where inflation is just hot all the time?
What a great question again, because I actually just read an article and I tweeted it out. I read a headline in the Wall Street Journal today that actually said a new use of the word transitory, where the economy is going to transition to a high inflation economy now. You remember before they were just saying inflation is transitory and will return to a low inflation environment? Well, the Wall Street Journal tends to be one of the leaks, the Fed leaks stuff through the Wall Street Journal. Now they're saying global central banks that inflation and economies may transition, so transitory, to long-term higher inflation. I actually believe that it's impossible for the U.S. to fight inflation using increased interest rates, because once they do, that accelerates the debt spiral. We talked about that. Right now, the USA only covers their interest expense one time, and that's with historically low interest rates, which is to say, as you increase the coupon by increasing the inflation fighting Fed funds rate, you're going to reduce your interest coverage ratio to below 1, which means your debt balloon is growing organically just because your interest expense is growing. Doesn't even count the new deficits. Oh, and by the way, we're going to write off school loans. I mean, this is a circus. It's a clown show, okay? And it's absolutely disgusting as someone who knows grade 11 math that these people are trying to gaslight us. I believe they'll have to change the inflation target from 2% to something higher, let's say 4%, because don't forget, we're at 8% in the USA, and Europe is even worse, okay, CPI. So they change the inflation target. They invoke some sort of what Luke Gromen, and here's the crazy thing, the IMF call the financial repression model, where bonds become a coupon on the bonds that's lower than the rate of inflation. Guaranteed you're going to lose money. Wow. After accounting for inflation. What kind of investment is that?
That's great.
Well, that's the investment that they want you to fund so that the math can actually work, so that the global GDP can grow at a fast inflation rate, and your interest expense is capped using a form of yield curve control or whatever. It's called the financial repression model. We talked about the IMF. I'm not a fan of theirs. I'm certainly not a fan of the financial repression model, but it's the only solution when you have total global debt to global GDP of 4-1. That's the math. The total global debt burden is 4 times the size of global sales or your tax base called GDP. Do some math, understand that if the average coupon on that debt is 3%, which is low in my opinion, but doing the math, that would mean that global GDP has to grow at 12% annually just to keep pace with the organic growth in the numerator. Again, 4 times the interest coupon, 4 times 3% is 12%. Do either of you guys think global GDP is going to grow at 12% annually for the rest of the time?
No. And not only that, I read an interesting thing recently, which is, global population is slowing down. The sort of new demand in markets is just not going to be growing at the same exponential rate that it was, 50 years ago during that boomer stage.
And Ben, very well said. But it was never exponential. Here's the neat thing. So the only way out of this is to grow the economy at an hot inflation, and hope that people are that stupid that they still fund your bonds. And if they don't, guess who's there to buy the bonds? The central bank. So currency debasement is guaranteed. 100% guaranteed. There's very few things in finance that are guaranteed. Well, guess what? Fiat debasement is one of them. So you better take that 100% certainty and adjust your portfolio and your risk baskets accordingly. Hence, I love Bitcoin.
I was thinking when we were talking about, I don't want to keep bringing up the IMF, but I'm going to mention it just probably one more time.
Just once more.
What I can't get my head around is that if the Fed are funding the IMF, then and more dollars are being printed, and the US dollar is the world reserve currency, it seems like impossible for the US dollar to fail. Then you've got the euro dollar system, which is kind of like a whole other thing I was learning the other day. Do you think that's true? I mean, it's just, for me, it's going to get so big, and
largely
other countries are going to get so pissed off with it potentially that they use other systems, and I think that could see the decline of the dollar that way. And I think it was Roll Powell that I've probably stolen some of his idea there, that he says that the dollar gets the problem will be it gets too strong. That'll be the death of it. What do you think about that?
Yeah, a lot of stuff in your statement there. So firstly, okay, yeah, right now we are experiencing a strong US dollar, but don't forget, fiats are all relative, okay? All fiats are melting ice cubes. They just have different rates of decay. So the US dollar is decaying. It's a melting ice cube, but it's not decaying as fast as the euro is.
Right.
Okay. And part of that reason is because they've jacked up interest rates, and it makes the US dollar an attractive safe haven. So I also like to say, look, the US dollar is the best crack house on a really shitty crack street, okay? Like, yay, we're all crack addicts, okay? Like, I mean, what the hell are you supposed to celebrate here? Now, the truth is the US dollar is a wrecking ball as well. You're seeing pressure on emerging market economies that always happens when the US dollar increases in strength, in relative strength. And the LDC crisis back in 1988, when I started my career, was driven by a relatively strong US dollar, and all these countries had taken out loans in US dollars. Okay. So their own currency the US dollar was strengthening. It took more of their own currency to pay the interest obligations on the US dollar denominated debt that they had incurred. They had to default. All of this can happen again and again. And here's the crazy thing. The USA will be the last fiat to fail. But in my opinion, the USA has already defaulted once. 1971, when they went off the gold standard, was a de facto default. Yeah. So look, there's something called default protection. It's called credit default swaps. It's a market that trades for the default protection to purchase default insurance, essentially on various countries. The USA has a default premium. There are people that are paying a premium to own default insurance on the USA. And it's as simple as this. It's a correlation with other more risky countries. If Canada were to fail, which it will fail before the United States, but Canada is the USA's largest trading partner, or perhaps second largest now. It's either one or two, China or Canada, number one or number two, USA trading partner. If Canada were to fail, and we're in bad shape, don't you think there'd be a knock-on effect to the USA economy and the ability of the USA to fund their own deficits? Of course there would. Therefore, you don't have to see an actual default in the USA to see the risk premium increase, and you need protection on that. And that's what Bitcoin is, in my humble opinion. Bitcoin is insurance on a basket of fiat currencies, which includes the USA. But Canada will probably default. Here's an answer to your question. I believe it'll take 10 years from the day Canada defaults for the USA, at least 10 years for the USA to default. And so all of these things are moving targets. All I know is you need to buy insurance when insurance is cheap. And I believe Bitcoin to be extremely cheap insurance against all these things you're bringing out. Don't overthink it, okay? This is a game of probabilities. That's what investing is a series of probability adjusted investments where you get an expected value on a bunch of possible outcomes. And on that basis, I think anything, as I said before, below, my number is 800,000, but let's even be conservative. Anything below 100,000 US dollar for Bitcoin is ridiculously cheap, in my opinion. It's the cheapest insurance I've ever seen, as well as being the best asymmetric investment opportunity. Put that together. If you own zero, you're not doing it properly. You're not doing math. You're not doing statistics, probability, expected values. So that's why I'm a pound the table. Don't listen to the conflicted viewpoints of the IMF. Don't listen to the conflicted viewpoints of Shifty Pete, okay? Shifty Pete knows that he is wrong. He's just too stubborn to admit his mistake. Raoul Pal, I'm not a huge fan of all the stuff he says, okay? That being said, I respect his ability. Even today, he came out and he said he's been wrong on bonds. Yeah. Okay, I salute you, sir. I salute you for admitting your investment advice has been wrong. Now, he frequently calls out Bitcoin maxis as being toxic and everything. I'm a Bitcoin maxi, but I'm not toxic. I try and tell the truth And I'm trying to tell people from the same type of logic that Raoul Paul has survived for his number of years in the markets. It's an expected value. It's a game of managing risk. And here's the key. Manage your losers. That's what you have to focus on. Let your winners ride and manage your losers. And very frequently people do the opposite. They cash in their chips on their winners and they hold their losers and pray that the information will change or that their investment will come back to break even. It doesn't work that way, people. And that's unfortunate that people have to lose the hard way, which is generally by losing money.
Yeah, Greg, I love your version of Bitcoin maximalism. I think it's a great antidote to, say, Michael Saylor's version where he tells people to sell their kids and buy more Bitcoin. I think, a sensible allocation is...
I appreciate that.
It's a much more balanced approach.
Well, I'm a huge fan of Mr. Saylor's, let's be honest.
Same, absolutely same.
He is absolutely one of the most incredibly intelligent people I've ever met. But you got to teach people to walk before you want them to run. And not everybody's a rocket scientist. Like he is a rocket scientist. Mm-hmm. Okay. So I actually went to a school called McGill University, a very good engineering school in Canada in my hometown of Montreal. And I actually went to school with some rocket scientists and most of them can't even speak. Okay. They're like walking computer mainframes. They at least Michael Saylor's a rocket scientist that can, talk to normal people, right? Makes arguments that at least the normal person can absorb. Most rocket scientists are not like that. I have to say, and that's coming from an engineer who was never a pure rocket scientist, but I did take some rocket science courses. And let me tell you, I mean, these people it's like they are walking computer mainframes, okay? They just don't typically... They're not able to converse with your common man, at least, or woman. And at least Michael Saylor is and he is exceptionally smart. Now, he says, don't own gold. He says, sell your gold to buy Bitcoin. I'll agree with that if you only own gold and nothing else. But if you own bonds, let's focus on the elephant in the room. The bond market is 40 times the size of the gold market, right? $400 trillion is global debt and gold is 10 trillion. Why are we focusing on this other thing that's 90% the population understands why they own gold? I mean, they're already there. Why piss off a group of investors that already know that the fiat ponzi is the problem? The gold bugs, hey, look, you can believe what you want, whether Bitcoin is better than gold. I absolutely hands down believe it is, but I still own some gold. And Larry Lepard, again, another guy who's I'm a huge fan of, very smart risk manager, Harvard educated, not a rocket scientist, but a good risk manager. He has made the decision that he is going to move his clients' allocation in hard assets more heavily weighted towards Bitcoin over time. But Bitcoin's a volatile asset. People need to understand that managing risk is it's as much art as it is science, okay? And then you have to handhold people and, oh my God, you got me into Bitcoin and it's gone from 70,000 down to 30,000. And you're like, yes, I got you into 1% of it. Now I'm going to get you into 4% of it because I can weight it average, discount costs, different, DCAing. And over time, you want to build your exposure up to a number that's meaningful. Meaningful can be anything to anybody as long as it's not zero. That is the wrong answer. So we can leave it there. Saylor's he's sort of, as far as distributions go, he's at the tail risk to the far right-hand side. I'm just trying to move people from the left-hand side, the people that have zero exposure. I'm trying to move them up the distribution because I think it's generational wealth, producing opportunity that unless you understand it, you're going to miss it. And if you miss it, it's your kids that are going to suffer. Okay. So do it for the kids. That's all I ask. Don't put your head in the sand and spout FUD like Peter Schiff does. He's doing a disservice to the future generations. Fat white guys like me are the problem from this entire fiat system. Okay. We're the most selfish investors of our lives. We are pulling forward benefits that should accrue to our children because we're too soft to pay our own bills right now. And it disgusts me that we will just blindly print money. We'll blindly write off student loan obligations. What about all the people that pay down their student debt by doing hard work? Don't you think they should feel disadvantaged by this blanket, we're writing off X number of dollars of student debt? Like, I paid all my student loans off. Now, mind you, that was over 40 years ago, right? Or no, I'm 50 something. So it was like 35 years ago. That being said, look, I don't feel great. I don't feel great that other guys are getting, a debt relief that, perhaps seems a little unfair. So anyway, long answer to the fact that Saylor is brilliant. If you have to listen to anything, listen to Michael Saylor over Peter Schiff. That would be my conclusion.
Yeah, that's a quality place to leave it, and I would echo that advice. Also, love your point. Let's do it for the kids. Get that Bitcoin allocation. I hope that our listeners tuning into this have learned a thing or two about risk management and just perhaps those that are sort of considering moving into an allocation of Bitcoin have been convinced, because this has been, one of my favorite episodes that we've done for a while. It's been an absolute pleasure to have you on, Greg.
My pleasure, boys. Thanks for everything you do and for helping to educate the world. That's the most important thing.
And I want to thank you for answering all of my questions. I know we jumped around a little bit, but there's things that bug me. And things that bug me generally means I'm trying to get to the truth of something. And I feel like now I've spoken to you, I'm a little bit closer, and hopefully other people will be as well. So what was it?
So can I make a shout out on that basis? I'd like to make a shout out not just to your show, but I'm involved in an education platform called LookingGlassEducation.com, okay? And this is a group of concerned young men and women who are trying to help educate the world about the truth, okay? About things like debt spirals that you won't learn in school, because they can't possibly teach it to you in school. Because if they taught you that the commercial banks where you comfortably deposit your money are actually so risky, it would. So this, anyway, LookingGlassEducation.com. There's it's a free website, free education. It's actually being translated into 18 different languages right now. That's and we've made a big dent in El Salvador's education, helping to educate them, providing some funding. So shout out to my mates at Looking Glass Education who are doing some great work for free. They're ladies and gentlemen that are based all over the world that are doing this. So this is why I love the Bitcoin community. I believe them to be one of the most generous, hardworking, and truthful communities that I've ever met. So thanks for having me again, guys. Pleasure. You guys are helping push move the needle and push the ball forward. So I look forward, hope to see you in Edinburgh.
Absolutely. You will, no doubt. It's been an absolute pleasure. And we'll put the link to the site that you spoke about into the show notes as well. So anyone that's interested to find out more, scroll through and give it a click.
We hope you enjoyed this episode. It would mean the world to us if you could leave a review wherever you're listening. This really does help and allows other people to find us online. You can keep up to date with new releases of the podcast by subscribing and following us on Twitter or Instagram for the latest crypto-related news. Information provided by Crypto Pulse via this podcast, website, social media channels, and any other medium does not constitute financial advice, investment recommendations, or any other type of advice whatsoever. The Crypto Pulse team are not professional financial advisors. Trading and purchasing cryptocurrencies do carry risks, and anybody wishing to partake in such activities should seek professional advice.